This day trader is crushing Warren Buffett and Cathie Woods. Oh, man. I didn't believe in day trading. Until I read this article. I said, wow, this guy, he's got it. He's got it, man. And maybe you can follow what his strategy is and you can beat Warren Buffett and Cathie Woods. Maybe. I don't know. So let's check it out. Meet the day trading hamster that's outperforming Warren Buffett, Cathie Wood, and the S&P 500. I guess there's a picture of him, but we don't see him. Mr. Gox is a trader that's outperforming some of the biggest names in business, and he's also a hamster. The road his trading streams are on a Twitch channel. He's nearly 20% return since he started trading in this June and is currently outpacing all the people we just talked about. When Mr. Gox enters a so-called Gox Capital office, a small box adjoined to his regular cage, a Twitch stream begins. An alert then goes out on his Twitter and Reddit accounts notifying his audience. Although he may leave immediately or sit still, sometimes inspiration strikes. His office is outfitted with a wheel and 2 tunnels that enable his trading. The wheel, aptly named the Wheel of Intention, rotates through a set of about 30 cryptocurrencies, one of which gets selected after he hops off. This is classic. When he goes off the wheel, he can go through either of the 2 tunnels in his office. One is labeled buy and the other sell, depending on whichever tunnel he traverses. A buy or sell order automatically takes place on an online crypto exchange using real money. A box in the upper right corner of the Twitch stream keeps track of his recent trades. A box at the bottom shows his account value and his returns. Despite his recent stellar performance, his owner, a 30-something lecturer and prototyping specialist in Germany, told the BBC that the project started as a hobby during the pandemic. The owner, who wanted to remain anonymous, worked with his best friend since college to put together the rodent setup. The pair emphasized to the BBC that they're not financial advice. It's only for entertainment purposes. Oh, that is classic. All right, so that maybe just kind of go back to the old classic, A Random Walk Down Wall Street by Burton Malkiel. What was this edition? I don't even remember here. 94, I think. So I can't remember. I read this in college. This is 1990, 91. So this is 91. This one, look at all these highlights. The security are called zero coupons or simply zeros because owners receive no periodic. So the first zero coupon were created by a major brokerage house in 1985. The Treasury itself began to provide more zero coupon bonds directly. I just got so many highlights in here. It's nuts, man. Let's see what else I got here. In addition, you should know that redemption. Okay, just anyway, it's fantastic. Malkiel used to be at Princeton. I think he's still around. But that was the first, anything you read by Bogle. And Malkiel is the Princeton guy. Just a random walk. Remember, we used to have Louis Rukeyser. You guys are probably too young, but back in the days, we had Wall Street Week. I got a thing in my eye. Rukeyser had the L's, and then on Wall Street Journal, they had the monkeys throwing darts at a stock chart, who would beat who, and it's just funny. All right, so then they all got down to the premise of Jack Bogle, basically starting the S&P 500 in 1973, the index, and he did research paper while he was at Princeton too. I wonder if Bogle and Malkiel they knew each other at Princeton. That probably. All right, then we go into, of course, The Misbehavior of Markets by Mandelbrot, and I tell you, this is one of the most classic investing books out there. Let's see, there was an era of. And I'm just going off a highlight. I have no idea what this is going to say, but let's read it. This was the era of Bourbaki, a mathematical club that, like Dada in art or existentialism in literature, spread from France to become, for a time, highly influential on the world stage. It worshipped abstraction and math for math's sakes. It scorned pragmatism, applications, or math as a tool for science. It was a dogma of the French mathematics and a reason why I ultimately left Paris for IBM. I was a young rebel, much to my uncle's consternation, and while working towards my doctorate, I'd often stop by his office at the end of the day for a chat. It often turned to debate. One day, during the long, dull metro ride home, I asked him what he could suggest for me to read, and he reached in his waistband and pulled out a discarded reprint. It was a review of a book by an academic character, George Kingsley Zimpf. Zimpf was independently wealthy, was a university lecturer at Harvard in a self-invented field he called statistical human ecology. His book, Human Behavior and the Principle of Least Effect, saw power laws as omnipresent pattern in the social sciences. Anyway, such power laws are common to physics, are formed what I now call fractal scaling. This is where fractal comes in. Anyway, this is such a good book, man. See if there's anything other highlights jump out here. In the 1970s, when the CAPM, whatever, pricing model, what the hell? I forgot what CAPM stands for. I'm drawing a blank. Anyway, when the CAPM and the Black-Scholes ideas were spreading, the way to get ahead in economics was to find evidence that they were right. So evidence was found and dissent ignored. This is such a good book. I love Mandelbrot. Nassim Nicholas Taleb talks about Mandelbrot a lot. So thus Markowitz and others transformed investing from a game of stock tips and hunches to an engineering of means, variances, and risk aversion indices. In fact, the term financial engineering has been popular on Wall Street ever since. There were problems, of course. First, as Markowitz himself pointed out, it is not certain that using the bell curve is the best way to measure stock market risk. It is easy, but not necessarily right. Second, to build an efficient portfolio, you need good forecast of earnings. Good forecast of earnings. Share prices volatility for thousands of stocks. Otherwise, garbage in, garbage out. For a 30 stock portfolio, but the minimum need to make the numbers work well, that means 495 different calculations of mean, variance, and covariance. For the entire stock exchange, New York Stock Exchange, 3.9 million calculations. And because prices change, the exercise needs constant repetition. This was a daunting prospect, even for the expensive IBM mainframes in the 60s that were starting to appear on Wall Street. Oh, such good stuff. All right. Then we go to this, models behaving badly, why confusing illusion with reality can lead to disaster on Wall Street and life. And speaking of which, Nassim Taleb writes about this. It gives a thing right there. My kind of book, an elegant combination of memoir, confession, essays on ethics, philosophy of science, and professional practice. Yeah. The difference between model and theory, and shows why attempts to model financial markets can never be genuinely scientific. It can't. And lastly, the best of the bunch, When Genius Failed by Roger Wallenstein, about LTCM. I don't think I highlighted anything in here. It's such a good book. But best-selling author captures the roller coaster ride of LTCM long-term capital management in gripping detail. When it was founded in 1993, it was hailed as the most impressive hedge fund in history, led by notoriously successful bond arbitrager John Merriweather. The firm hosted partnership with including not one, but two Nobel Prize-winning economists and a cadre of Wall Street's and academic elite traders. And then it went kaput because their models behaved badly. Anyway, point being is you can't beat the markets, man. I mean, you can, but it's just luck. There's no other way around that. In fact, if you look at, going back to McKeel, and we haven't talked about Bogle stuff, but if you go back to Burt McKeel, somebody's going to be lucky. Is Warren Buffett lucky? Was Peter Lynch lucky? Someone will be lucky. That's all there is to it. But you don't know who that lucky person will be in advance. You just don't. So just join the market. Don't beat it. Reduce your fees and move on. All right, we'll see you. Love to hear your thoughts.